Hello and welcome to this session in which we will discuss tax planning strategies. Now, what do we mean by tax planning strategies? What are we strategizing to do? Well, any entity, whether that entity is a corporation, individual, any tax-paying entity, they will try to do what? They will try to lower their taxes, lower their tax bill. Why? Because you want to keep more of your earnings. You want to keep more of your cash. You don't want to pay the government. You want to keep more for yourself, for your shareholders, to pay your employees, to pay your debt, to pay your expenses, so on and so forth. So companies, they will try to find or they'll try to explore certain tax planning strategy that's going to do what? That's going to lower their taxes. And that's the goal. To achieve this objective, which is lowering your taxes, companies, corporations use various tax planning tactics, and we saw this for individuals as well, to decrease their tax obligation. We're going to group those strategies into three key areas. The first area is timing. This involves deciding on what's the most favorable time to recognize revenue and expenses. Simply put, we have to choose in which period, assuming it's legal to do what? To report income and take the deduction. So companies can take advantage of lower tax rate or defer taxes to future period when they might be in a better position to handle this tax burden. Simply put, shift it. If you can shift the revenue for later, we'll take care of it later. More time gives us more options. That's one strategy, timing, and we'll have several recording about the timing strategy. Another strategy is income shifting. This involves allocating income or losses in a way to minimize the overall tax liability. How so? Well, we're going to have a recording for this, but just going to give you a taste of this. For example, transferring income to entities in lower tax jurisdiction, as long as that's legal, or to subsidiaries that can better absorb the impact of the income or the loss, by doing so, lowering our all tax bill. So income shifting is another strategy, and we'll have maybe 1 or 2 sessions about shifting income. The third strategy is making sure we are making our estimated payments to avoid penalties. Why? Because we are required to make payment on regular basis throughout the year as a corporation. Well, we want to avoid doing what? Underpaying our taxes. Why? Because if we underpay our taxes, we're going to be charged with penalties and interest. So by accurately estimating the tax liability and making timely payment, we can avoid unnecessary fines, penalties, interest associated with this. Now, in this session, I'm going to focus specifically on one strategy and specifically looking at the overall strategy of timing. How does timing plays into the tax planning strategy? So you have to understand the value of time, specifically a term called the time value of money. Now, I'm going to assume you know what the time value of money is. I'm going to explain it briefly, what's needed for this session. However, if you feel, you know what, I need more about time value of money, farhatlectures.com will solve your problem. I have lessons about time value of money where you would learn it from A to Z. Let's go ahead and get started. Before we proceed any further, I have a public announcement about my company, farhatlectures.com. Farhat Accounting Lectures is a supplemental educational tool that's going to help you with your CPA exam preparation as well as your accounting courses. My CPA material is aligned with your CPA review course such as Becker, Roger, Wiley, Gleam, Miles. My accounting courses are aligned with your accounting courses broken down by chapter and topics. My resources consist of lectures, multiple choice questions, true-false questions, as well as exercises. Go ahead, start your free trial today. Timing strategies. Timing strategies revolve around controlling over the timing, when to recognize revenues, when to record expenses, losses, and tax credits. Simply put, when to do so, when to recognize revenue, when to recognize expenses. So you have to understand the importance of this. The essence of this strategy is to adjust the moment when the financial element hit your tax return. When do you want that revenue to be reported? When do you want that expense to be reported? You might be able to shift them into a different period, into a different tax year, or either advance or delay the tax implication. Sometimes you want to delay the tax implication. You're going to see, like for example, for revenues, for expenses, you want to take the deduction now. We're going to see why in a moment. So the core principle guiding this strategy is, as I mentioned, the time value of money, which suggests that money available at the present time is more valuable than the same amount of money in the future due to its potential earning capacity. Here's what you need to know. $1 today is not equal to $1 a year from now. So you would rather have $1 today rather than $1 a year from now. Why? Because $1 today is worth exactly $1 today. If you have to wait to get that $1 a year from now, you lost 1 year of an investment. So if you have $1 today, what can you do with that $1? Let's assume you can invest it at 5%. Well, if you invest it at 5%, 0.105, I'm going to take this dollar, invest it at 0.05 times 1.05. The 1 is to get the principal. So I'm going to have $1.05 a year from now. Therefore, $1 today is worth more than $1 in the future. I want to make sure you understand this. Now we're going to look at the discount factor and how we compute the discount factor. But remember, $1 today is worth more than $1 in the future. And that has to do with many reasons. One is inflation. Two is risk. Do you want $1 today or $1 a year from now? You don't know whether you're going to get that dollar a year from now. There's always a risk that the person paying you might go away. There's also inflation. Inflation will eat up your value, the purchasing power. That's why $1 today is worth more. So this concept is crucial in tax planning. Again, I'm going to assume you know the basic time value concept, because by adjusting the timing of income or deduction, a company can influence its present and future tax liabilities in a way to preserve more cash flow. And when I say you should know it, I don't mean to, if you don't know it, it's a big deal. I don't want to keep repeating, go to farhatlectures.com and look at the time value lesson. That's what I'm trying to say. So we have to understand the difference between income versus deduction. Okay, what does that mean? It's important to differentiate between strategies for income and deduction, because remember, for taxes, we have income that's taxable and we have deduction that's deductible. Now, they have the opposite effect on tax timing. For example, income, the goal might be to delay recognition to future period. So every time you have income, for example, if you have, this is year 1, this is year 2, and this is year 3. Well, if you have the option to delay the income to year 2, you're better off. If you have the option to delay the income to year 3, you're even better off. Why? Because the more you delay it, the more you're delaying paying taxes on it. What does that mean? That's going to give you time value of money. So for example, let's assume your tax bill happens to be, it's a $10,000. If you pay the $10,000 today, it's worth $10,000 because $10,000 today is $10,000. Well, if they give you a year to pay the $10,000, guess what you will do? You will take something less than 10,000, let's assume 9,700, and you will earn 300 over this period. I'm just showing you the time value of money. Then in year 2, you will have the 10,000. Therefore, all what you have to do today is put 9,700. If they give you 2 years to pay this 10,000, you might only have to invest today, rather than 9,700, you might have to invest 9,400, and you will earn 600 in interest, and all you have to do is invest today 9,400, which is less than 10,000. I'm throwing these numbers out. I'm not making the proper computation yet, just to kind of give you the concept of the time value of money. Therefore, year 3, it gives you more time to put less money now. For example, by deferring income to a future tax year, a company can delay the tax payment, keeping more cash on hand in the present. So, simply put, here's what you have to know. Write it down. Defer income. Now, the assumption here is your future tax rate is either the same or higher, and the time value savings are higher than the changes in tax rate. So we assume your future tax rate is the same or higher. So you would always want to defer income. When it comes to expenses, what do you want to do with expenses? You want to take the expenses now. If you have any expenses, accelerate the deduction into the current tax year. You want to take the deduction now to reduce your current taxable income. Because if you can reduce your current taxable income now by 10,000, that's worth exactly 10,000. If you wait to reduce your taxable income next year by 10,000, well, you wasted 1 year of time value of money. Now your savings is worth less. Now you're going to see how we do the computation. But the point is, If you can take the deduction today, you will take the deduction today. You want to decrease your current tax liability, and again, to preserve more cash in the short term, because cash is worth more now than it is in the future, the same amount of money. So for deduction, aim to do what? To accelerate the deductions in the current period. So when it comes to deduction, the answer is take it now. The deduction is now because it's worth more now. Take advantage of the immediate tax saving to enhance the company's cash flow. Now let's work with some numbers for this to make a little bit more sense. So let's take a look at your after-tax income without factoring the time value of money. So what's after-tax income? This is what remains after subtracting the tax cost from before the tax. Well, let's assume before the tax you have income of $100,000. And you operate in a jurisdiction that will have a marginal tax rate of 30%. Could be 21, 30, it doesn't matter. I'm making the numbers simple. So we have to know what is your after-tax income. Yes, you did make $100,000, but you have to pay 30% on it. That's going to give us $30,000 in taxes. So after-tax income, after all said and done, you will end up with how much? You will end up with $70,000. So this is your after-tax income, $70,000. Now this is for just, I'll make sure you understand what after-tax income is. This is now. We're going to see later, if you can delay the income, it's going to be more savings for you. But we'll see that later. I just want to make sure you understand what's after-tax income. After-tax deduction. What is after-tax deduction? How does that work? Well, if you have a deduction, what is that going to do? If you have a deduction and you can take it now, you're going to be able to deduct the deduction, the expense, from your taxes. As a result, you're going to have a savings. So the bad news is you're going to have a deduction, which is negative. This is the deduction, which is, why I'm paying for this. Why is this good? Well, yeah, you have to pay for your expenses. You have to pay to operate your business. You have to pay your vendors. You have to pay your suppliers. But what's going to happen, you're going to get a tax savings. So what's going to happen? You're going to take your deduction plus your tax savings, and that's going to be your net deduction, which is your deduction after taxes. Let's work with some numbers. Let's assume you have a deduction for $10,000. You're going to say, oh boy, I'm going to have to pay $10,000. Well, you have to pay it. You're going to operate your business. Assuming we're in a 30% tax rate, here's what's going to happen. This $10,000 would reduce your taxable income by $10,000. Well, if it reduces your taxable income by $10,000, it means you saved on your taxes 30% of $10,000. It means you saved $3,000. It means your net cost of that $10,000, you paid $10,000, you saved $3,000 on your taxes, your net cost after taxes, or your cost after tax deduction is only $7,000. And this is what we mean by that. Now, how can you compute this? You can take this amount, which is $10,000, whatever the amount, times 1 minus your tax rate, which is 1 minus your tax rate, happen to be 3, and you will get 7,000 to figure out what is your net cost. So 10,000 times 0.7 is 7,000. So you can figure out what's your net cost. Same concept here. If you have a $100,000 times 1 minus your tax rate, 1 minus 0.3, it's going to give you 70,000 to figure out your after-tax income. But remember, this is income. You're getting less. You started with 100 with income and you end up with 30. You want to make sure you reduce your taxes. Here, when it comes to deduction, the higher the taxes, the better off you are, the more are the savings. But this is from a after-tax, before-tax income and deduction. Okay, just make sure you understand this. I mean, maybe this is easy, but I'm going to go over it one more time. Remember, when it comes to income, you think you're going to get 100,000, then the government says, I want 30%. You are left with 70,000. So for taxes, for tax rate, the higher your tax rate, the less you are going to keep. When it comes to deduction, you're going to have to pay this amount, but the good news is you're going to get a deduction. How much is the deduction? It's that amount times the tax rate. Now here, you would love to have, a different tax rate, one for deduction that's higher, one for income. That doesn't exist. But what I'm trying to say is, let's assume your tax rate happens to be 40%. Your tax savings are 4,000. So you end up paying 6,000 net. But again, you cannot have a different tax rates. But I'm just trying to make the point why how does the tax rate help with the deduction. Now let's introduce the concept of time value of money. Now we understand that what's after tax income, what's after tax deduction. We understand that it's always to defer the income. It's always good to accelerate the expenses. Now we're going to introduce the time value to find out how this all fits together. So when using timing strategy index planning, and we're going to see a few of them, the key factor to consider are the size of the income or the deduction, obviously, the marginal tax rate, of course, applicable to the corporation, and the discount factor, which reflect the time value of money. So the discount factor, it's going to measure the impact of time on the savings or on the, which is on the income or on the deduction. These elements combined, marginal tax rate, discount rate, income, and deduction, determine the present value potential tax cost or tax savings. Remember, one income you have a tax cost, one deduction you have a tax savings. Essentially calculating how much a future tax payments or saving is worth in today's dollar, because we want to bring everything to the present value to figure out what is our true cost. Now, how do we figure out this discount factor? It's a good chance on the exam they might give you the discount factor, but they might give you multiple discount factor. Here I'm going to show you how we compute the discount factor, just in case you have to compute it. Also, I want you to understand the math behind it. Why is this number this number? So the discount factor is used to determine the current value of future cash flow, like tax cost or savings, based on the principle that $1 today is worth more than $1 in the future. And I explained to you why earlier, due to the potential earnings capacity of money. So the formula to find out the discount factor is you take 1, the number 1, divided by 1 plus r raised to the n. Now let's explain what's in the formula. R is the interest rate. N is how many periods, and we're going to assume the periods is years. So in tax planning, the aim is to reduce the present value of tax liabilities, and by doing so, enhancing after-tax income, and to increase the present value of tax deduction, thereby reducing the tax expense. Well, given that the discount factor is always less than 1, the present value of $1 is always less than 1 for any positive rate of return, applying it decreases the present value of the future amount. And we're going to see what that means. It means once you take this present value and apply it, means multiply it by the amount that we are either getting the deduction or the savings for, it's going to be less. It decreases the present value. So for tax strategies, this involves timing decision over a year. The number of period n is typically set to 1. Now, it could be more than 1. You just, if you want to find the factor more than 1, you raise it to 2. Again, most likely you will not have to do so, but it's very important to understand how the discount factor works. Let's work a quick example. Suppose a company anticipates a tax cost of $10,000 next year and is considering an investment opportunity that offers 6%. To decide the present value of this future tax cost, we use 6% R, which is R equal to 6% and equal to 1. Let's find the factor. The factor is, if we take the formula, it's approximately 0.9434, which is 1 divided by 1 plus 0.6 raised to the 1, which is 0.9434. What does that mean? Well, you have a taxed cost, but that taxed cost is due next year. So how much it's worth today? In other words, yes, next year you have to come up with $10,000. But the question is, how much is that cost? What's the present value of that cost today? Well, the present value of that cost is you will take the cost times the factor. The cost of $10,000 times the factor that we computed. So the true cost of this $10,000 is $9,434. This means that given the opportunity to earn 6% elsewhere, a tax cost of $10,000 next year is effectively $9,434 today. Because you have to pay it next year. Well, guess what? You have more time. In other words, you can earn some. So in other words, you're not paying $10,000. If you have to pay it today, you pay $10,000. If this cost, if you're gonna defer this for next year, then all we have to come up with is $9,434. By understanding and applying this concept, the company can make more informed decision when to incur tax cost or realize tax savings. Now, the same concept applies if you have $10,000 that's taxable now versus taxable next year. You want to defer it for next year. Again, here just to kind of illustrate the discount factor, how we use the discount factor. The discount factor always less than 1. Therefore, when you take this number multiplied by the amount, it's going to be less than the original amount. Now let's apply everything that we learned about deduction and income, as well as the time value of money, to see how it works. For tax cost, what's your tax cost? You're going to take your pre-tax income, whatever that amount, times your marginal tax rate to figure out your tax cost. Then what we're going to do, we're going to take your tax cost, and if you can defer your tax cost, we're going to multiply it by a discount factor to figure out what's the present value of your tax cost. Well, let's say a corporation has a pre-tax income of $50,000 and a marginal tax rate of 25%. Well, let's start simple. If we have to pay the tax bill today, it's 50,000 times 0.25. We have to come up with 12,500 today. Let's assume we can defer this payment a year from now. And the discount rate, it's 5%. And if we compute the discount rate factor, it's 0.95, which is already computed for us. So our cost today is 12,500. If we can wait a year from now and pay this bill a year from now, we only have to come up with 11,875. In other words, today we'll put away 11,875. We let it grow at 1.05. What does that mean, let it grow? It means invested. That's what we are saying. So if we take 11,875 times 1.05, it will grow to be approximately 12,500. Now, let's do it the other way. Let's take 12,000 the way we learned it. 12,500. Yeah, it's correct. If we take 12,500 multiplied by 0.25 is 11,875. What we're saying is, if we take this amount today, 11,875 multiplied by 1.05, we will have a year from now 12,468, which is rounding approximately 12,500 because the factor is 0.95. It might be maybe it's a little bit higher due to rounding we're doing with 0.95. But this is what we mean. We can take this amount, 11,875, invested, because that's what we're assuming we can invest it. There's an investment capacity for this money. Therefore, we only have to come up with 11,875 versus if we have to write the check today, we have to write a check for 12,500. For tax savings, which is when we have a deduction, we're going to take the pre-tax deduction multiplied by the marginal tax rate. And let's see how this works when it comes to tax savings. Then we're going to take the tax savings multiplied by the discount rate to give us the present value of the tax savings. Assume a corporation has a pre-tax deduction of $20,000. Well, calculate the tax savings. Well, let's assume this is at $20,000 and we can take the deduction today. If we can take the deduction today, we're going to take 20,000 times 0.25, and that's going to give us a savings of $5,000. So here's the computation. We're going to get a tax savings of $5,000. If we have to wait a year to get this tax savings, so let's assume we cannot take this deduction now, we have to wait 1 year from now. If we have to wait 1 year from now, we have to take the 5,000 multiplied by 0.95. Well, what does that mean? It means the tax savings is now $4,750. We lost $250 because of the time value of money, because we want to tag the savings now. If we have to wait, the savings are worth less because we're not getting the 5,000 now. We're getting the 5,000 a year from now. A year from now, 5,000 is worth less for us than now. So we would rather take the deduction now. The point is, defer the income as we saw here, defer the income so your taxes are lower, and accelerate the deduction. The present value of the deduction is higher. Today, $5,000 deduction is worth $5,000. A year from now, $5,000 deduction is worth less. How much less? Depending on the factor. Here we're assuming 5%. Let's take a look at this multiple choice questions from farhatlectures.com. If a corporation expects to have a tax cost of $20,000 in 1 year and the discount rate is 5%, what's the present value of this tax cost? Well, looking at the answers, can we eliminate any answers immediately? Well, because the tax cost, the tax deduction, cannot be realized until a year from now. Well, what does that mean? It means it's not going to be equal to 20,000 a year from now because there's the time value factor. Well, the tax cost will not equal to 21,000 because it cannot be higher than 20,000. That's also the case because what we need to do, we need to take this 20,000 multiplied by a discount factor. Now, what does that mean? the discount factor is always less than 1. The present value of a discount factor is less than 1. The present value of a single amount for a discount factor is less than 1. Now, we are not giving the discount factor, but we need to know how to compute the discount factor. How do we compute the discount factor? We'll take 1 divided by 1 plus 0.05, which is the 5%, raised to how many period? 1 period. If we perform this computation, we are going to get a present value factor of 0.9524. Now what we need to do, we'll take 20,000 times 0.9524, and that's going to give us $19,048 rounding. Now, what's the point here? The point is you could have eliminated 2 answer choices immediately, and you're down to 50-50. Now, if you have to guess, I'll go with the 9,048, but you don't have to. You perform the computation if need be. What should you do now? You want to go to Farhat Lectures, look at additional resources, MCQs, that's going to help you with your CPA exam, accounting courses, enrolled agent, or any other professional certification you are studying for. Invest in yourself. Good luck, study hard, and of course, stay safe.